Hi, this is Karen Lin. In Chapter 4, I want to illustrate the consolidation process when NCI, non-controlling interest, is present. In the previous chapters, we talked about consolidation process with the parents owning 100% of the subsidiary. In this chapter, I want to illustrate when the parent does not own 100% of the subsidiary but only a portion of the subsidiary. So how does the consolidation work? First of all, I want to talk about the idea of the non-controlling interest. So the idea of non-controlling interest, which we brief as NCI, is that there is another shareholder or other shareholders that own smaller than 50% of the company. So the parent company now is called the CI, the controlling interest, and the rest of the shareholders that owning the subsidiary is called the NCI. Let's look at a very simple case to illustrate my point. Excuse me. So let's look at two companies, the parent and the subsidiary, before acquisition. Okay, before acquisition, the parent has $100 cash, no investment, other assets $300, total assets added up $400. So the liabilities of the parents $150, shareholders equity $250. You can see 400 minus 150, 250. So total liability plus stockholders equity $400. The subsidiary has similar structures, and the shareholders equity is $40. We know that when the parent bought the sub, the parent is buying the voting stocks of the subsidiary, which is the shareholders' claim. So let's assume first the parent owns 100% of the subsidiary, which means the parent bought the subsidiary for $40 in cash. Assuming no goodwill, no overpayment, the parent paid exactly $40 for the subsidiary for simplicity. So we after acquisition, I updated this before acquisition account. Cash would be 100 minus the $40 we pay for the parent paid for the subsidiary's net assets, and in the meanwhile, the investment is $40 because it's the stockholder, it's the net asset of the subsidiary. Everything else stays the same. It does not change other assets, liabilities, or the shareholders' equity of the parents. So basically, it's just a redistribution of resources between the cash and the investment. The subsidiary is not affected. Now you will ask, the parent paid $40 to the subsidiary. Why didn't the subsidiary's cash increase? Remember, the cash is not paid to the subsidiary per se. It is paid to the subsidiary's stockholders so that they could give up their shares to the parent's shareholders. That's the idea. So when we consolidate these two companies, we first add them up, right? If I add them up, this is a simple add up of the two. But remember, if I do this, I add them up. So this is chapter 2 through chapter 3, is that if I add the two companies up, there is a double counting of my investment account and the subsidiary's net assets. So if the investment needs to go to 0, so we will make this go to 0. You see then my stockholders' equity, liability plus stockholders' equity is not equal to the total assets anymore. That is because we also need to cancel out with the CI's equity. So we basically need to make the parents' shareholders' equity equals to the consolidated stockholders' equity. So remember, the S entry, we always cancel out the common stock and additional paid in and the retained earnings, one of the subsidiary. That's the idea. So basically, this number should equal only to the parent's number. You can see now they are the same. Again, let me say that again. It is because we cancel out the investment account of the parents with the with the subsidiary's net assets. Now let's assume the parents. This is chapter 4. Let's assume the parents does not own 100% of the subsidiary, but only own 80% of subsidiary. So the NCI, non-controlling interest, owns 20%. In that case, the parent only paid the $40 of the net assets, which is here, but only paid 80%, right? So the parent paid 32. So this is, we use the parent's cash minus $32, and the investment increased by 32. So everything else is not affected. The subsidiary is not affected because the cash is paid to the shareholders of the subsidiary. So you can see now we are going to consolidate the two companies according to the acquisition method. The parent, when it controls the subsidiary, it has to consolidate 100% of the assets and liabilities, which makes sense because the parent controls 100 through voting, through 80% voting stock controls decisions of the subsidiary, which means it controls 100% of the assets and liabilities. So when we consolidate, we add them up 100%. So 68 at 50 is 118. And so on. So when we add them up, we see it's the same. But, I mean, the total assets equals to liability plus stockholders' equity. But we still see a double counting here because the investment account is basically the stockholders' equity of the subsidiary, or the net asset of the subsidiary. So we need to cancel these two guys out, right? Remember, the consolidated stockholders' equity is only the parents. So we have to cancel these two things out. If I cancel it out, so I cancel 32 here, and then I basically cancel out the 40 here. So it equals to this guy. Now you can see my total asset does not equal to my liability plus stockholders' equity. Why? It's because we add up 100% of the assets and liability of the subsidiary, but we only own 80% of the net assets. So basically we add up 40, but we only own 32. So where is the rest 8? That is owned by the NCI, which is the non-controlling interest. So if I put it back, I put the 8 to the non-controlling interest, the total assets will now equals to the total liability plus stockholders' equity. So let me say that again. We are canceling out the investment and the net assets. Because we add up all 100% of assets and liability, we need to cancel out 100% of the stockholders' equity of the subsidiary. But we only own 80% of them, which is $32. So there is an $8 difference goes to the non-controlling interest because the 20% of 40 is 8. 20% is owned by the non-controlling interest. So this is a simple case to illustrate the idea of NCI.